In video 3, we're going to have a brief look at what determines interest rates. We're not going to go into a lot of detail in this because I'm presuming that you will have covered this in a number of your economics classes, but it is very important to understand what are the factors that determine interest rates. And note that this is obviously going to be a critical factor for you to examine in your assignments and when you enter the workplace. So what are the key things that you're going to need to be looking at to determine or to come up with a forecast for interest rates and hence your cost of debt? So, as I said, from your economics classes, you'd know that there's a couple of key economic factors that are really going to affect interest rates. So first of all, what's the real growth rate in the economy? So is the economy growing at a very rapid rate? And therefore, what's going to be happening in terms of monetary policy going forward? Will the Reserve Bank in Australia need to increase or decrease interest rates depending on the economic activity in the country? And what's the long-term projection? Is that going to be a high rate of growth for a long time? Or does the future look quite subdued? Again, if we look overseas, what's the European Central Bank going to be doing? What's the Federal Reserve in America going to be doing? What's the Bank of Japan going to be doing? So again, another factor could be the tightness or the ease of capital markets. So how much capital is there in the market? What's supply and demand? And so obviously supply and demand determines price, and that will determine what yield is or what the interest rate is. As you'd know from economics, what's the expected rate of inflation? So that's going to impact our nominal rates because all of the interest rates that we're looking at in finance are nominal interest rates. So we need to understand what's the real rate of interest and what's the expected inflation, because that will then affect nominal interest rates. When we're looking at a particular bond, how is the interest rate affected on the bond? Well, what are those factors? First of all, what's the credit quality? So how risky is this particular debt? Is it very high quality, and so the margin on top of risk-free could be quite small? Or it could be very risky, could be a junk bond, and so the margin or the default spread could be quite large. What's the term to maturity? So how long are we going to be holding this bond? That will obviously affect the interest rate as well. What are the indenture provisions? What are the contract terms between the bond issuer and the bondholders? Obviously, the more favourable the conditions to the investor, then we have less risk, and therefore we'd be willing to have less of an interest rate. And then foreign bond risk, so exchange rate, country risk, sovereign risk, will also impact on the interest rate that we would demand. The term structure of interest rates refers to how interest rates for the same quality, how that interest rate changes in terms of how long it is until maturity. And so there's a couple of different hypotheses. Three of the most common are expectations hypothesis, the risk premium hypothesis, and the liquidity preference hypothesis. So expectations hypothesis is simply that any long-term interest rate should simply represent the geometric mean of current and future 1-year interest rates expected to prevail over the maturity of the issue. Whereas liquidity preference theory states that long-term securities should provide higher returns than short-term obligations because investors are willing to sacrifice some yield to invest in short-term obligations to avoid the higher price volatility that comes along with long maturity bonds. And segmented market hypothesis assumes that or states that different institutional investors have different maturity needs, and that leads them to confine their security selection to specific maturities. And so the investors either have a preference for short-term, medium-term or long-term, and then the supply and demand within those different segments of the market will then affect the interest rates within each of those segments. And so market participants match the asset life and the liability life or maturity to establish a low risk position, and then premiums are required to encourage participants to invest outside their preferred habitat or their preferred segment. So often this segmented market hypothesis could be called the habitat theory. Sometimes people differentiate between the two of them, but they are quite similar in my opinion. So the yield curve is basically looking at this term structure. So what is the average yield for Australian government bonds 3 years out? What's the Australian government bond 5 years out? What's the Australian government bond 10 years out? And we can see in table 2.7 that usually, not always, but usually interest rates are lower for the shorter term maturities and slightly longer for the longer term maturities. Sometimes that can invert, where short-term interest rates are higher than long-term ones, and often this is a case of an overheating economy, and so the Reserve Bank has had to increase interest rates quite high, but the market believes in the long-term rates will be lower. Table 2, you can see yields on shorter term securities, so 30-day bank bills, 90-day bank bills and 180-day bank bills. And again, normally, but doesn't always have to be the case, normally we see that the shorter term securities have a lower yield than the longer term maturities. And we can represent this in a graph by looking at maturity on the x-axis and the yield on the y-axis, and we can see that government bond increases slightly over time but is relatively flat. We'll come back to the other colours in the graph in later videos when we're looking at the difference in terms of credit quality of various assets.